Hello everyone, happy Monday. It is March 20th. Today on the Final Bar, we're going to talk about how the market is reacting to the news out of Europe. Credit Suisse going down, UBS taking over. What does that do to the US markets? Not much. US markets hanging in there just fine. Technology at the bottom of the leaderboard today. Ladies and gentlemen, this is the Final Bar. Hello everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. Chip Anderson, our founder, started the StockCharts platform a couple decades ago as a way to educate, inform, inspire individual investors, really empower online investors to make better decisions. And we do that through powerful tools to help you quantify investor psychology and analyze market dynamics, education to help you learn how to apply these tools in real-time situations, and then expert commentary from people like John Murphy, Larry Williams, who did a fantastic members-only presentation last week, Martin Pring, many others. We hope on the Final Bar we can just give you a taste of some of the expertise that you have access to and really try to inform and educate on what we're seeing and hearing. A lot of news flow over the weekend, and yet again, it was a weekend where we heard additional news hinting at these ripple effects of this banking crisis that feels less and less contained as with every headline. However, the U.S. markets today actually pretty resilient. Asia, Europe actually trade a little lower. U.S. markets open actually pushed to the upside. We're going to break down the charts and much more here as we get into our market recap. As I mentioned in the introduction here, major averages holding in there. The Nasdaq was testing the zero line for quite some time, but actually bounced up to close the day up 0.4%. The S&P 500 up 0.9%, and the Dow really leading the way. Mid caps and small caps outperforming large caps. And when you think about the sector distribution or the sector performance, the FANG sectors were at the bottom of the list today. The sort of value-oriented or cyclical sectors and some defense at the top of the list. And basically when that is the configuration, you pretty much can expect that mid caps and small caps are going to do better than mega caps, which is a very growth-oriented group of stocks. Volatility coming off, and so as we think about the VIX, what does this tell us? Overall, I would argue still a volatile environment with the VIX well above 20. It's pulled back a bit, about 1.3 points, but still holding above 24. Elsewhere, looking around the financial markets here, we have interest rates, the entire curve basically moving higher today. Of course, we have the Fed meeting coming up this week, Tuesday, and then into Wednesday. Wednesday certainly expect to have quite a bit of volatility as investors digest the latest announcement from the Fed. We'll have Powell's press conference, which usually injects a lot of uncertainty and a lot of volatility into the markets. Usually the Fed week, the days leading into this meeting, usually relatively quiet. Now this is unusual that we have all this sort of other news flow kind of coming around related to interest rates. So the traditional playbook may be upended this week, but usually you'd expect a little bit of quiet. Rates overall moving higher as bond prices coming off. So equities moving higher today, bonds moving lower. Kind of a bit of a reversal to that safe haven trade we talked about last week with Ms. Schneider and others, where bonds were rallying and stocks were coming off. That stock to bond ratio recently breaking below its 200-day moving average. On Friday, we highlighted that chart. The dollar continuing to move lower as well, down another 0.6%. That's using the UUP ETF. Commodities overall mostly positive. Gold and silver where we focused recently because gold has been so much stronger than the dollar and certainly so much stronger than crude oil. Up a little bit, but really more flat for the day. Silver up about 0.25%. Copper, crude oil prices both in the green as well. Finally, cryptocurrencies, I would argue more choppy than anything if you look at the last 12 to 24 hours, but overall pushing higher. Bitcoin currently just below 28,000, Ethereum just below 1,800, around 1,760. Let us look at a chart of the S&P 500. We'll check in on what that is telling us. Again, what I like to do on the final bar is look at what happened today and try to connect today's activity to the bigger picture, right? What did we learn today? What's different? What's new? And how can this help us, understand better the dynamics here? As I mentioned, usually kind of a quiet period in Fed week. So we're chopping around kind of the same range we were on Friday. So today is what you'd call an inside day, where you had a range yesterday, and then today the high and the low are within Friday's high and low. That's called an inside day. That's more of a bar chart sort of terminology that you would use, kind of similar to a, what is it called? I'm totally blanking on the candle pattern. The inverse of a bullish engulfing pattern is what we'd be looking for. A bullish harami, I believe it's called. It's not exactly a perfect version of that, but kind of close. What is interesting today on the S&P 500 is we're closing back above the 200-day moving average. And I've mentioned a number of times, one of my early mentors used to say, nothing good happens below the 200-day moving average. So getting above the 200-day and staying there, I would argue, really important if you're bullish, if you're looking for recovery, if you see this February to March period so far as being a counter trend move before we reinitiate the uptrend. First things first, we have to stay above the 200-day moving average. So closing above there today, encouraging, let's stay above there. Let's have that follow-through day. What's interesting is on Thursday of last week, we had the move higher, then a down close on Friday, an up close today, and overall, we're sort of still within the range. It's a series of inside bars actually every day. So if you look at the larger picture, which is what I want to pay attention to, think of the lower end of this range since late December as 3,800, really going back to November, as around 3,800. The upper end around 4,100, 4,150. We're almost at the midpoint between those two extremes. We're literally at the middle of the range between these two, and the 200-day moving average kind of flat right in the middle. So this is the definition of a sideways market. The RSI is almost dead neutral at 50. We are truly in wait and see mode, and I would not expect big catalysts before Wednesday. There's a lot of sort of quiet period, the holding our breath collectively before we learn from the Fed whether we get a rate hike or not. Currently, the market pricing in pretty likely that we get a 25 basis point hike. It's actually bounced up from the end of last week, but we'll see. Going back to the main dashboard, let's just check on a couple other things here. In terms of sectors, I mentioned some of the cyclical stuff like energy, materials, industrials, what we consider more value-oriented sectors at the top of the list. Consumer staples actually creeping up through the course of the day, and by the end getting in the edging out industrials for third place. Energy and materials both up over 2% today. The technology sector, consumer discretionary, communications, services, these are our FANG sectors, all in the green, but just narrowly so, right? And if you look at something like Microsoft, has been arguably one of the better charts out there, holding up while the major averages have been struggling to do so, actually mean reversion. So again, it's more value-oriented stuff up, more growthy stuff that's actually down today. Let's go to the chart of Microsoft here and let's just look at this in a little more detail. In the short term, what's happening is Thursday, we had the move higher. Thursday, obviously a big update. Friday, we opened and traded higher, but by the end of the day, Microsoft, not a perfect, what you call a shooting star candle, because there's a little bit of a lower shadow, meaning we traded a little bit below the open, but overall, sort of a distributive pattern, right? Closing more in the bottom half of the day. So today, kind of trading lower out of the open makes a lot of sense if you think of the candle chart, because it basically what that candle pattern is telling you is last week on Thursday into Friday, we were retesting the February high, but Friday's candle actually telling you there wasn't enough momentum to push really significantly higher off of that open. And then, of course, today coming back a little bit. By the way, Microsoft just touching the overbought region on Friday as well. Last time we touched the overbought region was in early February. That was sort of at the end of this rise higher. So are we entering a scenario this week where the growthy stuff kind of comes back a little bit? Rates maybe go higher. That's more in general constructive for value-oriented parts of the market. That's what happened today. I don't know. We'll have to see what happens through the course of this week. But Microsoft may be an important chart to watch because at this point, stalling out after Thursday and Friday's rally. Intel is another interesting one to watch. Now, when you look at semiconductors, Intel is kind of an outlier, kind of a different business than a lot of the others. You're going to have NVIDIA, Intel, and then a bunch of other things. But if you look at the chart of Intel, again, purely from a technical perspective, look at the high in mid-November, look at the highs in December, in January, in February. 4, 5, 6 times we've tested that same level. That's around $30 a share for Intel. Once again, over the last week, we've traded back up to 30 after bouncing off the lows. We have now hit the 200-day moving average. On Friday, we traded above it. We closed back below it. We're following through to the downside today. So Intel has tested its 200-day moving average a couple times in the last year and a half. It has not finished well in any of those previous times during the distribution phase, starting really in early 2021 for Intel and then continuing through the course of most of 2022. Bottomed out in October. From there, it's more range bound, and at this point, we're at the upper end of the range. So if you're bullish and you're thinking constructive from here, I can't disagree that that's a potential outcome, but I would need to see charts like Intel actually, not trading, as we've said before, not trading to resistance, but trading through resistance. So far, this chart is looking like another attempt to get above 30 and a failure to do so. Until an Intel can get above 30, power above the 200-day and follow through, it's more of a range that is still in place, what we call a consolidation area. A range-bound market, a consolidation zone, a lot of times just looks like a rectangle, consistent lows, consistent highs, and that's kind of how I would describe Intel over the last 4 to 6 months. Let's continue on and look at some of the other charts that I think tell the story of what's going on here. One of the ones that I want to go to is part of the Mindful Investor Live chart list, and that is the what I call the chart of offense versus defense. We had a version of this chart that we showed last week, but I just want to revisit it because staples were one of the top 3 sectors today. Consumer discretionary, one of the bottom 3 sectors. And the more that happens, again, that just tells you investors within consumer are rotating more to things you need over things you want. And when investors are rotating more to these staples, things like household goods, cleaning supplies, beverages, alcohol, tobacco, toilet paper, things you're going to need in any environment versus things you want, a new car, a new house, travel, tourism, discretionary purchases. When those are underperforming the staples, that is not a risk-on type of fuel. So interesting that in the last 6 to 7 weeks, it's been a clear rotation away from consumer discretionary into consumer staples. As long as that line continues lower, that's really telling you it's a risk-off environment using this particular indicator. Just to finish off here, let's look at one other chart because we have time for it. We're going to say Caterpillar, right? When I'm looking at charts that are at interesting levels, Industrials has a couple. Caterpillar and Honeywell, I think, are both worth paying attention to. Caterpillar because it's potentially bouncing off of the 200-day moving average, while Microsoft is trying to get higher and potentially failing. Caterpillar oversold as it's approaching its 200-day moving average last week, bouncing off today, up about 2.5% today. That's not too bad, right? We'll see if that's able to continue. Now, Honeywell actually broke down through its 200-day moving average, but watch this. If we do a quick Fibonacci analysis, we take the low from September, we take the high from November, take that to where we're at right now. You can see as of Friday, we're actually trading down to the 61.8% retracement, bouncing higher. We at a point where some of these industrial stocks are finding a floor. I think the rest of this week, hopefully we'll answer that question. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is such a pleasure to be in this brand new studio. We're making continuous improvements to this space. Thanks so much for your feedback as we sort of get settled in the new space, but we're excited to keep upgrading our ability to illuminate the markets for you. A couple quick announcements before we continue on opening the Final Bar mailbag. First off, we welcome your questions, your feedback, particularly your questions, though, as you are trying to analyze the markets using the Toolkit of Technical Analysis. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We would love to hear from you. Hope to answer your question live on the air end of this week. Also, upcoming schedule tomorrow, Samantha LeDuc, founder of LeDuc Trading, will be coming through. She is really good to bring in on a Fed week. Good big picture thinker, macro environment. We'll see what charts are telling the story for her. Wednesday, Thursday, Friday, I will be out going to Disneyland with my family. My friend Julius de Kempener graciously agreed to host the show from Amsterdam. He has 2 guests to tell you about. Bob Lang from Explosive Options next Wednesday, and Thursday, March 23rd, Adrian Zadunchik, founder of the Bird Nest, cryptocurrency expert. Also, upcoming webinar. If you go to marketmisbehavior.com/crisis, you will see the info on my upcoming webinar, which is tomorrow, Tuesday, March 21st, 1 p.m. Eastern, called Charting a Financial Crisis. We'll talk about the charts that really illustrate the situation we're in, particularly the financial sector, but also interest rates and elsewhere. We'll talk about the major averages, revive the old market bottom checklist, and look at where we're at relative to some traditional signals of market bottoms. You don't want to miss this analysis of the current crisis, how to make sense of Fed Week. Go to marketmisbehavior.com/crisis to sign up for that free upcoming event. Let's continue on our show today, opening the final bar mailbag. As a reminder, all these questions come from viewers like you, and please keep them coming. Here's question number one. What is the MOVE Index, and what is it telling us now? It's a really, really good question. I appreciate you asking about it. I've heard a lot about it in the news recently as well, and it's something I've looked at before. The MOVE Index is actually the Bank of America Merrill Option Volatility Estimate Index. That's what MOVE stands for, Merrill Option Volatility Estimate. Think of this as a VIX for the bond markets is how I would generally describe this. Now, we actually don't have the MOVE Index preloaded in StockCharts. The really cool thing about StockCharts is we have what are called user-defined indexes. So I was able to get the data from another source. I was able to import it as my own custom index called @MOVE. You're welcome to do the same. Just find the data, get it into a CSV file. You can import it into StockCharts, and now I can chart the MOVE Index on the top half of the screen and the VIX on the bottom half of the screen. I'm going back the last 2 years. And here's what I would generally say. If you look at the contours of these two charts, and what I mean is just look at the general shape. When are they moving up? When are they moving down? You can see, without running a statistical correlation, you can see the correlation pretty high, right? When the MOVE Index is moving higher, the VIX is in general, and when the MOVE Index is coming down, the VIX is as well. Makes sense because they're both measuring volatility in the options market. It's just whether you're looking at the volatility of equity options or index options, which is what the VIX is doing, or bond options, which is what the MOVE Index is doing, really on bond futures. So you can see how the MOVE Index has really been rotating higher in February and March. The VIX has done the same, but the reason why a lot of people are talking about the MOVE Index, two reasons. Number one, it's moved up even more. So the MOVE Index is actually making a new high going back way back. Actually, I think this is going back certainly to 2020. We're higher than we were back then. I think we were in the 160 range back then. So we're really making a new swing high here for the cycle. The VIX, of course, well below the volatility we saw just in the highest points of 2022. But also in general, the bond markets tend to lead the equity markets. That is the general, order of operations I was taught when I was learning about investing. Any of the equity investors that I really was able to work with over time, they really wanted to understand where market sentiment was. They would look to bonds first, usually because bond investors are really fine-tuned into risk. And when things are getting bad, bond investors tend to get ahead of that, whereas equity investors tend to be a little more optimistic. So the fact that the MOVE Index is leading the way higher is not a good sign for stocks because it suggests uncertainty that's not quite being priced into the equity markets yet. Really good question, and thanks so much for bringing that onto the show today. Next question. The width of the market has narrowed. Are we setting up so the generals are the only ones left? And you quoted someone that said the last to go are the generals. That's actually a really interesting question as well. And when you think about, the generals, right? It's sort of think about the military, right? The generals versus the infantry, right? Versus the privates. And it's a common sort of way of thinking about investing, about thinking about those mega cap stocks, those leadership names that are most likely leading the way higher. In general, pun intended, when the generals are doing well, when those big mega cap, those FANG stocks are doing well, conditions are probably okay. What's interesting right now, though, is if we use the Qs as a proxy for the generals, right? Sort of those mega cap FANG stocks, and you think of I don't know if the S&P, maybe the New York Composite Index as sort of the private, right? Sort of all of the infantry reporting up to the generals. The Qs are doing much better, right? They're performing much better. You can tell by just the fact that the Qs are outperforming the SPY. Does this feel good? Not necessarily. Now, there have been times like 2011 where the market goes higher driven by those mega cap stocks, those FANG stocks. But however, if you think about what we've learned more recently, this has been, I would argue, more of a safe haven play where people are rotating to the relative stability of Microsoft and Apple and Nvidia as opposed to some of the more speculative emerging growth types of stocks. So these stocks rallying and continuing higher and other things not really participating, that I would argue would be a cause of concern. And I agree with you. The fact that small caps are underperforming, the fact that the Qs are leading, not necessarily a bullish sign, but the contours of this market, the dynamics of the market can very much fluctuate. And I think a lot of that is going to have to do with interest rates and what we learned this week from the Fed. Great question there, by the way. Next one. On your Mindful Investor blog over the weekend, you showed all time frames are now negative on your market trend model. Any significant that all the lines are together? Really good question. So if you go to what's called the articles page, there's one of the articles I wrote on Friday. It's called Market Trend Model Turns Bearish. And what I did was write an article just going into a little more detail about something we talked on this show on Friday, which was the fact that as of Friday's close, my market trend model, which is looking at weekly data and looking at 3 different time frames, turned all bearish, right? All 3 time frames now bearish. That doesn't happen often. That's the 4th time it's happened in 2022, but only the 12th time since 2000 that you've actually had that combination, what we call a bearish trifecta, with all 3 of them turning negative. In my opinion, that is not a great sign. In general, I would much rather these be bullish than bearish. But your question is, what does it mean that the lines are all on top of each other? The short answer is, I don't think a ton. For me, it's less about where the shape of the moving average is and more about what it tells me. These moving average comparisons are basically taking 3 different combinations of the moving averages I'm showing here and looking at the spread between them to measure the performance over those 3 different time frames. So this is really the sweet spot for me, looking at the difference. Now, when you show that, when you mention that all of the moving averages are together, the way that's expressed on this chart is when we're right at the 0 line and kind of flattening out. And that is kind of what's happening. So I don't have a neutral setting, but if I did, I would probably say long-term neutral, medium-term neutral, short-term bearish. But I don't. I try to keep it super simple. I try to simplify and say thumbs up, thumbs down. And at this point, it's all thumbs down. I think that's the most important message to watch. Really good question there. Next one, do most people draw trend lines using closing prices or highs and lows? This is actually the type of thing that myself and my CMT friends in the industry will have extended hotel lounge debates as to what the right opportunity is, where you should draw trend lines from. The reality is a lot of the techniques that we use today, things like trend line analysis and patterns, were really derived and created and discovered, I guess, or popularized when stocks traded very differently, right? If you look at the Edwards and McGee book written in like the 1950s and 60s, if you look at John Murphy's book written in the 1970s, if you look at Wells Wilder's book, Martin Pring's books, all written around that time, this is when stocks were trading on 8s, right? So it was really common that you would have a series of levels that were identical. So when you talked about a level hits a precise point and then turns, that was actually way more common before we had decimalization, before we had stocks trading at sub pennies, before we had bid-ask spreads so tight, which is what in some cases non-existent. So this is not the kind of thing that I would argue that you can read. I'm not a purist where, if you read Edwards and McGee, if they say a certain way, that's the gospel. I think you have to adapt what they wrote for how the markets are evolving. So if you think about what I've been talking about, I've actually shown 2 sets of trend lines. I've done the intraday lows, which means you're using this low down here around 3,500 on the S&P, connecting that to the intraday lows there and lining it up to where we're at today. The other option would be take the closes, which would be that one, and the angle is actually very, very different. So this is one of those times when I actually showed both of those trend lines. We talked about that on the show because I don't think there's a clear-cut answer. So here's what I would generally say. I would say people in general are split. The books that I read, and most of us read, insist on using intraday highs and lows because that is a trade, that is where the market got to, and that is the extreme. I have found simplifying is a really good idea, and so actually just skipping this and just looking at the closing prices, which means you change it from an open, high, low, close to just what we call solid line, which basically means you're getting rid of the intraday movements and just looking at the close. If you're doing a bunch of trend line analysis, I actually find this a way simpler way to make sense of it. For a couple reasons. Number one, you're focusing just on the closing data, so you're drawn less to extremes and more to the key, most important points, which are the daily close, and also you have a really clearly defined level at which we should close through to consider that trend line violated. So that's why I would argue that using the closes in this sort of environment, I think makes a lot of sense to me. And if you look at what's happened, they both have triggered a sell signal on the S&P 500 over the last couple weeks, really from mid-February to late February into early March. All of those, regardless of what you used on the S&P, we've now broken those lines to the downside. Suggests overall that the trend is now lower. Really good questions. Thank you guys so much. We have to wrap the show. Go to the 3 in 3 charts in 3 minutes that tell the story of this market environment. Here's chart number one. The question about the generals really led me to think a lot about leadership and laggardship. And I was thinking about one of my mentors, Greg Morris, who's a longtime StockCharts contributor, a fantastic author and market expert, also a successful pilot, former Top Gun instructor, and had a successful career at Delta Airlines. So I've had my favorite conversations with Greg have been about flying and relating that to investing. But when I talk to Greg, he often considers the NASDAQ to be the benchmark because that's, the story of the U.S. markets are a story of growth, certainly in recent history. So if you're thinking about modeling the U.S. market, he always uses the NASDAQ as opposed to the S&P for that reason, because that's the future, right? Those are the technology and sort of forward-looking companies that we should be looking for strength from if things are going to get better from here, arguably. So when I'm looking at the Qs, it's like, forget that we have a sort of mini financial crisis that is becoming less mini. For every Credit Suisse that goes under, I feel like there's less mini and more we have to remove that and call it a full-blown banking crisis. However, the fact that the Qs are testing a new swing high, not even carrying the fact that all these headlines are going on, I think is important, right? As long as the Qs hold support, as long as a Microsoft pulls back but doesn't break down, the market, as defined by the NASDAQ 100, is still okay. And I think it's important to look at leadership, in this case, semiconductors, mega cap technology, and consumer names and communication names. Do they hold up? For now, it is saying, yeah, things are fine. These stocks are holding support and are still, by definition, in an uptrend. Chart number two, let's look at two key measures of economic strength and economic risk aversion, which would be copper versus gold. Copper tends to work when economies are growing because you need raw materials to build things and make wires and all that kind of stuff. So copper prices going up usually means economic conditions are improving. Gold doesn't go up because it's not a really usable thing. It's not like you can build something from gold. It's something fun and exciting that tends to hold its value in periods of instability. So when gold is working over copper, it tends to be more of a risk-off environment. Look at the copper to gold ratio. Look at how it bottomed in July of last year, and from there was in a good uptrend. So when you think about signs in October that the market wasn't going to weaken much from there, the fact that the copper to gold ratio was trending higher, I would argue, is probably one of those important signals diverging from the equity benchmarks in a bullish way. Look at what's happened, though, in the last month or so. Peaked out in February, little after the market actually peaked out, and from there, the copper to gold ratio has rolled over. Now, does this have a lot of tie to China and headlines from there? Absolutely. Does it tell us, leading or lagging indicators? That's debatable as well. However, I have always felt way more confident about market strength when copper is outperforming gold, and we're not seeing that. So again, if you're bullish, I would be looking to see if this ratio could turn higher. At this point, it's telling you more risk off. Just to finish off, our last chart of the 3-and-3 NRG Energy. And I don't want to make a big call on this particular stock, but just to illustrate the benefits of candle charting. Candlestick charting is a Japanese form of analysis, really predates most of the Western tools, what we consider Western tools like moving averages and bar charts and all that really came after Japanese rice traders in the 1600s created an early version of what we now call candlestick charting. If you look at this, it is a visually rich form of analysis. It really helps you understand the dynamics moment to moment, day to day. Look at how we set a low in mid-December. Look at how we retested that low in mid-January and once again retested the low in March. Look at this candle pattern right here. This two-bar pattern is called a bullish engulfing pattern. A down candle, an up candle, day two's bar, or day two's body engulfs the first day's body. That same bullish short-term reversal pattern happened in mid-January. So a chart like this is a great reminder to keep it simple, and let's look at candle charts. Folks, that's a wrap for the show. Thanks for joining us on a Monday afternoon for all of these charts and more. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. See you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.